One of the most important parts to achieving financial independence retire early is being able to track your progress toward your financial independence goal. That's why in this video, I'm going to be taking a slightly different approach to talking about FIRE than I have in my previous videos by focusing specifically on what you can do to track your progress toward financial independence. Hey everyone, and welcome to FinTech. And in this video, I'm going to be going over some core concepts of FIRE that we can track, and then using the Google Doc in the description of this video, I'm going to show you exactly how you can track your own progress toward financial independence and eventually help you retire early. Financial independence retire early, or FIRE, is the idea that by saving and investing a large percentage of your income, you can eventually build up a large enough investment pool that you can live off its proceeds forever. This method has allowed many in the FIRE community to retire as early as their 40s or even their 30s, much sooner than previous generations ever thought possible. The very first step to achieving FIRE is to track your expenses and your income in a budget. In the description of this video, I have my personal budget linked, which you can use as kind of an outline for creating your own budget to start tracking your expenses today. So let's walk through that budget now. So I have pulled up right here the budget that I actually follow every single month, which records how much money I'm making and how much I'm spending. So if we zoom in here, we can see that I have my income highlighted in green, I have my expenses highlighted in this kind of beige color, and then I have all of my savings and investments highlighted in blue. If we go to the bottom of this sheet, we can see that my net total for my expenses as well as my savings equals 0. This means that every dollar that I have going into my account, either through my paycheck or through my rental income, is assigned to either an expense or a savings account that it's going to go to after the fact. This is called zero-based budgeting, and it's a really useful way to make sure that you have complete control over your money. Using this, we can also calculate exactly how much of my money goes to savings versus expenses. So again, if we zoom in here, we can see what my expenses are each month, as well as how much my money goes to savings and investments. By then taking my savings and investments number and dividing it by the total amount of my savings, investments, and expenses, we can see that just over 44% of my money goes to savings and investments every month. By following a strict budget like this, you can tell exactly where your money is going each month. For example, in the budget I just showed you, you can see that exactly 55% of my income goes towards expenses, while 45% goes towards savings and investments. Once we know how much money we're going to be saving each month, the only other thing we need to know in order to forecast how much money we'll have in the future is to understand how much money our investments are making us. Now, depending on the types of investments you have in your own portfolio, that number is going to vary. For example, if you're only investing in treasury bonds with the government, you're going to make around a 1.25% interest rate each year. If you invest in real estate, your numbers are going to vary depending on what real estate market you're working in, as well as how much effort you're willing to put into finding deals. In my case, I'm investing primarily in the stock market. Now, the stock market isn't as consistent as some other forms of investing. As you know, in some years it can go up by 30 or 40%, while in other years it can actually drop in value. These short-term fluctuations are really hard to predict, but by looking at the market performance over a long time horizon, we can start to see some averages for how the stock market will perform over a 20-year period. So if we use the S&P 500, which is just an index made up of the 500 largest US companies by market cap, we can see that on average, it goes up around 10% per year. To account for inflation, we could lower that number to 8% per year, and then you can use that number in your calculations to determine on average roughly how much the stock market is going to make you each year. So using the information that we now have, we can actually use an Excel spreadsheet to forecast how much money we will have at any point in the future. So going back to this same Google Doc, which again is linked in the description, we can see how this works. So right here in this Google Doc, I have this section for the estimated amount that'll be in each of these different accounts after the end of each month. So we have home equity here, home debt, student loans, Roth IRA, 401k, brokerage, and then on the right side here, we have the totals added up, which will show what your net worth will be at the end of each month projected into the future. Now, the way that this projection works is just taking how much money you're expecting to add to those accounts every month and adding on the investment gains that you expect. So for example, looking at the Roth IRA here, this tracker started in June of 2019, which is when I started tracking my expenses exactly. If we look at this number here, this $29,000 is how much money I had actively invested in my Roth IRA 401k at that time. If we go one cell down, we can see that what I'm doing is adding on the interest that I expect this account to accrue on an average month. So I'm taking 9%, which is around what the stock market will return on average per year, and I'm dividing that by 12 to just calculate how much it would return in a month. Now, obviously, the market isn't actually going to return that amount, but over a long-term time horizon, it should average out to around the right amount. Then for the Roth IRA specifically, in order to account for how much money is being added to the account, in January of each year, I add on an additional $6,000. That $6,000 is the maximum that you're allowed to contribute to a Roth IRA, and so I try to max that out in the first month of each year just to give that investment as much time as possible to grow. Similarly, we can look at the 401k category. In this case, the amount increases by a larger amount each month because I'm actively contributing money to the 401k every single month. If we go back to the budget that we looked at earlier, we can see this amount right here is how much I contribute to my 401k each month. So we can actually use that number in our calculations to forecast how much that'll be worth in the future. So if you use this Google Sheets document yourself, this number is actually being pulled dynamically from the budget. So whatever number I have listed in my budget under 401k is going to get pulled into this calculation here and calculated automatically. Using a spreadsheet like this allows you to estimate into the future how much each of these different accounts will be worth, and then from that you can calculate what your net worth will be at any month in the future. Now, obviously, this isn't going to be entirely accurate because in reality, the stock market fluctuates. In some years, it could go down, and in some years, like this year, it could do more than double what we would expect in an average year. Because of this, in addition to tracking my estimated net worth at the end of each month, I also track what it actually was to see how close that estimate actually was. So you can see that at first, these two estimates were fairly similar, but they diverged over time. So this number right here is what the estimate for my net worth would have been in January of 2021, assuming all the assumptions I made back in June of 2019 held true. Now, in reality, those numbers diverged somewhat, mostly due to increased stock appreciation, especially in my Roth IRA and my brokerage account. If you've watched any of my previous stock reviews from this year, you'll know that my stocks increased by over 300% this year, which is a lot different from the 8% that I was forecasting. So while this sheet can't predict exactly where you're going to be several years from now, it can give you a pretty good estimate for at least where you're moving financially. Now, the last thing that we need to know is how much money do we need actively invested in order to retire. The easiest way to calculate this is to just take your yearly expenses and divide it by 0.04. This is what's known as the 4% rule. Basically, by only withdrawing 4% of your investments each year, you will never run out of money because your investments will continually replenish that amount through the income that they're earning. Now, the reason that we use 4% instead of, say, 8% is because the market isn't consistent. Some years it'll go down, but in those years, you still need to withdraw money. By only withdrawing 4% each year and being more conservative, we can make sure that even if the market performs poorly, you will still have enough money to live on. So if I use my numbers that I showed you before, my expenses are $3,882 per month. And I'll just assume that those are around the same as they're going to be in retirement. If we multiply that by 12, it comes out to $46,584 per year. So that's my yearly expenses. And now all we have to do is divide that by 0.04 using the 4% rule. That gives me a number of $1,164,600. So let's just use $1.2 million to make the numbers nice and round. That is how much money I need to have actively invested in order to retire. So now I can use that number and plug it into the last tab in that Excel spreadsheet. So in this Google Sheets, I created a third tab where I created a thermometer chart that shows how close you are to financial independence based on your current net worth. So let's look at that now. You can see here that I have this thermometer which essentially shows how close you are to financial independence, going from 0 here at the bottom all the way up to your final financial independence number. What's great about this sheet is I don't have to manually update it. It just takes the net worth that I have listed right here and the financial goal here and then creates this chart for me. Now this net worth number, I don't have to update. It actually pulls automatically from the net worth tab by just looking at what the last filled in row is on the actual net worth table that I had showed you a little bit earlier. When you combine this with the financial independence goal number that we calculated a little bit earlier, this gives you this great visual representation of how close you are to financial independence. Now again, if you want to use this chart for yourself, you can just use the Google Doc that I have linked in the description. So to recap, we created a budget which we can use to forecast how much money we're going to be able to put towards savings and investments each month. We then created a spreadsheet which can track our net worth progress every month, as well as forecast what our net worth will be at any point in the future. Finally, we use that information to create a thermometer chart, which can show us visually how close we are to achieving financial independence. If you found any of this information useful, let me know in the comments, and also check out that Google Sheet and let me know if there's any changes that you would recommend. With that said, I hope you enjoyed this video. If you did, make sure to leave a like, and if you don't want to miss out on any future videos, make sure to both subscribe and hit the notification bell. I'll see you next time.